Hello and welcome to Pro Trader Strategies market commentary for Thursday, October the 31st. Happy Halloween. My name's Eric Wilkinson, and yes, some of you may recognize me as the Wolfman from mainstream media. What I'm here to teach you guys is not only how to build different option strategies, but how to implement those and how I trade, manage that risk, and all of the other things that goes in and around building a trading portfolio. Anyway, without further ado, remember past performance of any trading system or methodology is not necessarily indicative of future results, and let's get it on with some economic data. From across the pond, we got German retail sales, and of course, it did come in lower than expected at 0.1%. It's not really that surprising. Expected to be at 0.3%. Still positive there, but then last month's number did come in slightly revised, actually quite a bit revised, from 0.5% to negative 1 or 0.1%. So German retail sales not doing very well as we would expect. We're seeing a recession over there, and it doesn't look like they are coming out of that anytime soon. We got French preliminary CPI coming in at negative 0.1%, expected to be a positive 0.1%. Spanish flash GDP coming in line with expectations at 0.4%. And then we got the CPI flash estimate out of the European region that came in at 0.7%. In line with expectations. They did revise last month's number down by 0.1% though. And then core CPI, which is consumer price index flash estimate, came in at 1.1%. That's better than expected. Now remember, the core CPI is a bit of a better gauge of the overall picture because it strips out food, energy, alcohol, things of that nature that can be a little bit more volatile. Then we, what else was there? I thought there was a European flash GDP for the greater region came in better than expected at 0.2%, expected to be a positive 0.1%. So just slightly better on that front. Now back to the United States, we got our PCE, which is personal consumption expenditures. That came in at unchanged. It was expected to be a positive 0.1%, so a little bit lower than expected there. Employment cost index in line with expectations at 0.7%. Personal spending a little bit lower by 0.1% than what was expected, coming in at 0.2%. They did revise last month's number up by 0.1%, so it was somewhat of a wash there. Personal income unchanged at 0.3%. They did revise last month's number up by 0.1% though. And unemployment claims coming in at 218,000, which is pretty in line with expectations. Now we got the Chicago PMI, Purchasing Managers Index. This is ahead of our ISM PMI, which comes out tomorrow. That's our most important economic data point, but it's still something to look at here. Chicago PMI coming in at 43.2, expected to be 48.4. Now these PMI numbers aren't necessarily, above and below the 50 like we normally see with the ISM, but we are seeing that, aren't as important as the ISM, but it is below 50, which showing Chicago isn't doing too well and dragging on the economy. Natural gas storage is coming in at 89 billion cubic feet, a much bigger build than what was expected at 47 billion cubic feet. Now, like I said, tomorrow is the ISM manufacturing PMI. That is the one to really look at. We hope to see that one come in above 50, but it is expected to be below 50 at this point, and that would mark three shots in a row. That is pretty indicative of a recession down the road, or at least moving into a recessionary type economy. So don't want to see that. The Fed, yesterday did lower interest rates by 25 basis points. Now we're at 1.75 for the overnight rate. They did basically come out and say that they're ready to hold off on any further interest rates to see more data-dependent information. Well, I think that if we get this ISM tomorrow from the PMI numbers, that is going to really signal that we need to start lowering interest rates even further. All right, now on to the markets. We've got crude oil coming off again today by another $1. We're peeling past that point of control. I've talked about this time and time again. I think that we are going to stay below 55, somewhere between 50 and 55 if the economy continues to slow, we could really see that market start to come off even more as the lack of demand coming out of the manufacturing sector for the distillates is going to wane on demand for crude oil. So crude oil coming off a little bit again today. All of these markets are going to be reflective of that Chicago PMI. That really was a wet blanket on the markets. And now ISM tomorrow is expected to come in below 50, and that is going to even wane on the markets even more. We've got the gold futures moving back above 1,500 a troy ounce. That's on the expectation that the Fed's going to continue to lower interest rates despite the fact of what they said yesterday. These guys are really behind the curve, you guys. So, the markets are trying to signal to them as to what we see and those levers and pulleys going on. Hopefully they take heed to that and really start playing catch up with the overall market. All right, we've got gold, like I said, back into that 15 handle. I kind of expect it to stay up in that 15 handle, especially with the way that the markets are looking these days. We've got bonds up almost 2 points on the day, but it is approaching that value area high. We are back in the 160 handle or the 60s, I should say. We blew right through that 160 handle, just slightly settling below that 160 yesterday. As you can see here, if we pull up this settlement where we got 159.31, it was just one tick shy of that. So this support and resistance and that psychological level of 160 is holding true, like I've been talking about for months on end. I expect us to stay up in a 60 handle for probably the foreseeable future, really. That would be the next few months at least. Then we move over to the VIX. VIX is starting to spike here. We're back into the 13 handle. Yesterday we had that big rally. VIX came off, but now with this PMI number and the expectations of tomorrow's unemployment number and the ISM number coming out not looking too good, this market is really trying to signal that the economy may not be doing as well going forward as what was hoped for. All right, and we've got the Dow Jones off better than 250 points on the day. We've got an engulfing candle over there, which is not a very good sign. Not really an engulfing candle here with the NASDAQ off by about 50 points. Yesterday we really got a big rally on that lowering of interest rates. The market was thinking, okay, we're looking pretty good, easy money. That should help out the major companies. As they have lower interest rates, they can start borrowing and spending, and that's supposedly good for the economy, right? All right, so NASDAQ off by 50 points. We've got the E-mini S&Ps, another engulfing pattern here. Not so much in the NASDAQ, but we did see that in the Dow Jones, and now seeing that in the E-mini S&Ps after creating that all-time historical high yesterday after the FOMC, but now moving back down into the value area. So again, similar to what we were seeing over there in the crude oil. Remember, we've been talking about how it was going to fill in, create a new volume node. We could easily see this start to build in right in and around this 2950 area and start to see the market start to fill in some of this low area here. So that's going to be something where when we bounce back and forth on this 23 Fibonacci area, you got the 50-day moving average line right here as well. So that's going to act as support. But I do kind of expect us to kind of start toggling back and forth above and below that area, maybe even come down and test this 2900 area as well in the mini S&Ps. Let's take a look at the 30-minute chart of the mini S&Ps. You can see right here after the FOMC came out, we really got a nice big rally. Market did start to get a little bit short, and we continued that short tone coming into the day session that was based on the Chicago PMI also. But overnight, inventory pretty short, got even shorter today, which means that there is a really bearish tone out there. When you don't try and flush out those overnight inventories, then overnight longs and or shorts, and the market continues that pattern during the day session, it is usually a sign of bearishness in this case. All right, let's talk about a couple of the trades that I've done, and thankfully I got out before the Chicago PMI numbers because the market's really started having a fit here. With Facebook, excuse me, with Facebook, I went in and played this to the upside. Facebook seems to have been doing very well as of recently and usually beat on their earnings, so I wasn't too concerned about this. I'm going to have to start really thinking about adding shorts for some of these earnings plays because the economy not looking too good going forward. Even if they beat, like we saw with Amgen beating on those big rallies that they ended up selling off as well. So I think that we could start seeing more of that going forward as they may even beat, but just the overall bearish undertones in the markets is going to cause some of these stocks to show some weakness. But with Facebook, I went into the November weeklies and sold the 170 puts in there for 53 cents. I was able to buy those back for 2 cents this morning. With Apple, I got a little bit more aggressive with this. With Facebook, I went outside of that 16 delta, which I usually talk about in the earnings webinars as to my rules. But that one I was a little bit worried about on Facebook. Apple, I believe that they are doing well with their streaming and a lot of people signing up for that. Their wearables are really big. I thought, a lot of people were buying the new phone because I've seen a lot of those out there. That being said, I played this to the upside. They aren't selling as many phones as I was expecting. So maybe I'm in some kind of bubble where the people, my friends, are all buying those. Anyway, the November weeklies, I went in and sold the November 230 puts, which basically puts me very close to this support area of the 161 extension. I probably should play around with these Fibonacci's again because I have no more Fibonacci's above this, so I want to get some more data for that. So with Apple, it did get a nice rally right off the open, but you can see basically on the PMI numbers and some of the earnings call they were talking made some of the investors have a little bit of pause. But anyway, like I said, I went in and sold those 230 puts in there for $1.40. Was a little bit more aggressive with these, for $1.40, and was able to buy those back this morning right on the open for 8 cents. I think I might have been one of the first people to trade that strike this morning. But now you probably could get out maybe right in and around where I got out for a while there. It wasn't looking too good. We saw those premiums start to spike a little bit on that. But we got the directionality right on both of these trades right off the open. That volatility crush, which enables you to get out for pennies from where we got in. All right, that's about it. Today's webinar is going to be on the Christmas tree. So this is a great strategy. It's a bit of a twist on the butterfly. So if you, especially, I didn't used to love this strategy, but I'm starting to like it a little bit more now that everything is commission free. There's a few more legs on this strategy, and that usually eats into our profits a little bit when we had to pay commissions. But now that we don't have to pay commissions on this, we can build as big a strategy as we want. And the Christmas tree is one of those strategies that has a lot of legs, but we increase our probabilities of success over the butterfly with this by adding just a little bit of risk, and I'll show you how to build that out today. So it's all about implementation. It's not necessarily about how you just build it. So check that out at protraderstrategies.com, and I hope to see you there. If you can't take that, take it easy.